Almost everyone you know wants to figure out how to retire early from the stock market, but few people know how or what it really takes. And while I do believe you should shift your focus from wanting to retire early to financial freedom, because as humans, we always want to work, right? If you retired and you had nothing to do, even if you could say to yourself, oh, I wouldn't get bored, I promise if you don't have purpose, you will be miserable. So, even though I don't believe your thought process should be figuring out how to retire early, but instead learning how to create financial freedom and then using that money to help more people and create more financial freedom for yourself and for your family, I'm going to show you the realest strategy that is going to work and ultimately is better than anything you've probably seen on the internet so far today. So here we have arguably the two most important charts in the entire world, right? We have the S&P 500, which represents the biggest 500 companies in the planet, and we have the NASDAQ 100, which represents 100 of the biggest tech stocks in the planet. Now, when you zoom out, right, because we're looking at the weekly time frame, and if you don't know what the weekly time frame means, it means that every single candle here represents 1 week. So you see this big red candle, 1 week. Or you'll notice how the last 3-4 weeks have been big red candles. I'm sure if you follow this channel or if you've been following the stock market that you know that, right? But when you zoom out and you look at the highest time frame possible, right? When you zoom out as much as you possibly can, you notice that it really just only goes up, right? If you bought it and forgot about it from July 2017 up until now, you would have 3x'd your money. And ultimately, trying to short this market, in my opinion, is just chasing after fool's gold. So when people hear, oh, retire early from the stock market, they immediately think, I'm going to be a day trader, right? I'm going to learn how to short. I'm going to learn this insane strategy that I've never heard of before. And the reason why it's flawed is because when you think about it, the market over the long term is only going up. So what exactly is day trading, right? What are you even trading, right? Because, if you're a day trader, you're probably looking for the move each individual day. And yes, when you look at the candles, you don't really know what each day is going to bring, right? Like, I believe when you actually study every single daily candle of the S&P 500, it's like 51% are green, 49% are red. But how then is the market only going up, right? It doesn't really make sense. How is it that if half the days are red and half the days are green, the market's only going up? And obviously the answer is that the green days are bigger than the red days by average. So, when you actually think about it and you look at the chart, it makes you realize that day trading doesn't really make sense, because why would I be going back and forth on a chart that only goes up, right? Like, for me, I day traded for years and I was always flip-flopping. I would go long, get stopped out, go short, get stopped out. And I would end the day always red. But then when I zoomed out and I realized that the chart just kept going up, it didn't make sense to me, because I was like, wait, how am I losing, right? Like, for years, I was this losing trader and I saw the market only going up, and it just didn't add up to me, because I was like, well, if I had just been long the entire time, I'd be fine, right? And then it also hit me like, the only account that is doing well for me is my long-term investing account. Now, I understand, right? You probably are watching this because you don't want to just buy and hold the S&P 500. You want to create substantial income and retire as soon as possible. So I'm going to show you a strategy that makes the most sense. If you're someone who is into trading but realizes day trading isn't for you and wants to make more out of the market, you're willing to take on that extra risk, then I'm going to show you the number one strategy. And the best part is you don't need to guess which stocks, you don't need to guess the daily direction. You can just, implement it and create cash flow and create income. So let's get into it. So I changed the chart view, and what we're looking at now is TQs and UPRO, which is essentially the same thing as what we were just looking at, right? UPRO is the S&P 500, but it's leveraged 3x, and the TQs is the NASDAQ, but also leveraged 3x. Now, you'll notice the difference in stock price. It's $76 and $62 as opposed to $500 and $20,000. So the reason why this is important is, one, because you're getting leverage, so there's more volatility. Because, let's be real, right? For most people, just buying and holding the S&P is just not going to do enough, right? If you have $1,000 to your name or $5,000, 10% a year is just not going to cut it. And two, since it's cheaper, you can buy more shares and ultimately implement option selling strategies. So we're going to focus on these two ticker symbols for our retirement strategy, for our way of becoming wealthy. Now, when you look at these charts, you'll notice something very interesting. When it comes to the TQQQ chart, you'll notice how it came up to this high in November, and this is the top. Now, when we pull up the actual NASDAQ chart, right, what you'll see is that this high that we're looking at in November, the same high that TQQQ barely beat in the real NASDAQ completely demolished it, right? So for us, the decay is a little bit too much on the TQQQ side, but when we shift the focus over to the S&P here and then UPRO, right, you notice how UPRO still took out the highs. It did come back, right? So it still is, hanging in that level, but we like that it took out the highs as opposed to, like I said, the TQs getting rejected at the highs. Now again, when you look at the S&P, you'll notice that it's still, 18% higher than the highs, where with UPRO, it's roughly at the same level. So you're missing out on a good roughly 18% at the moment, right? Now, with that being said, you'll also notice though that the volatility is a lot crazier, right? When we came to this low and came to this high, it was a 57% move. And when you do the same thing here, you'll see it was a 164% move. So you have to take the leverage and the volatility as a gift and a curse, right? The curse is that if you hold on for it too long, that it might not come to the highs the same way that the S&P or the regular NASDAQ did. But the gift is that in bear markets, if you buy the bottom of this, you can actually see a 100% plus return on an investment where, obviously in this case, it's only a 40-50%. So how are we going to implement this, right? I know you're probably saying, well, even if I did buy the bottom, right, 100% is still not enough. Now listen, first of all, 150% from, December 2022 to now is great, but I'm going to show you guys the strategy that makes the most sense and how you can use it to your advantage. So now we have the UPRO option chain up, right? And the reason why we're going to So now we have the UPRO option chain up. Now it's very important to understand what options truly are, because I think a lot of people get confused due to this degenerate world we live in. They only think of options as a way to flip, $100 into $1,000. But the reality is, what an option is meant to be is it's meant to be a way to leverage 100 shares without owning 100 shares. So in this case, UPRO is $76, right? 100 shares would be $7,600. But if you were to, let's say, buy a call that expires in 13 days, you would pay $440, right? Now, the reason why this is so important, let's see, do I have a 2 option? Hold on a second. Let's just remove that. Okay, so the reason why this is so important is because, again, you're controlling 100 shares. So if the stock moved 100 shares and you had 100 shares, then you have $7,600 worth of risk on the table. In this case, you're only putting $440 worth of risk on the table for 100 shares worth of movement. That's the leverage that options give you. Now, of course, when you buy a call this close to the money and this close in expiration, you're putting yourself at a good chance of losing the entire $440. So what we're going to do is we're going to go out roughly as far as we can. So let's say January 15th, 2027. Now, the reason why we're doing this is because when it comes to options, your biggest battle is against time. So when we go further out, we're giving ourselves more time. And you'll see I already own this one here at $70. So for $2,400, right, I am now controlling 100 shares. So I'm controlling $7,600 for $2,400 for the next 2 years. Now, what makes this special is when we pull up my positions, what I'm also able to do is I'm able to sell a call against that leap that I own. So in this case, right, I'm already up $75, and this entire call will produce me $220 in passive income from now until April 4th. And what makes it special is the only way it's not going to produce that income is if the leap that I own goes up in value, right? Because look, when we look at the simulated returns, right, and we keep going higher and higher. So as you know, my strike on the call that I sold was $80, right? So let's see, we go all the way to 80 and we would be up $293. But look, we're still below 80, so we would still collect that $220 that we're owed on the option we're selling. So the beautiful part with this is it's very similar to like a rental property, right? When you own a rental property, you want to collect income regardless of if the house appreciates or depreciates. In this case, you're collecting income regardless, yes, but if it appreciates, even better. So in this case, right, we have this UPRO leap, we have this TQQQ leap, and ultimately, as you can see, this TQQQ leap is down $1,800 because the market has been getting crushed. But the beautiful part is we've been selling covered calls against it the entire time. Now, I'm not going to go through how many covered calls we've made or how much money we've made selling covered calls, but the beautiful part is that we have this leap, which again, we're controlling $7,500 for only $2,200 at the moment. And on top of that, we're collecting roughly $100 to $400 every 2 weeks. So even when the 2 years is up, right? Because we have 2 years to control this. If we're collecting $100, let's just be conservative and let's say $300 a month, right? We have roughly 20 months. 20 times 300 would be $6,000, right? So even if we were able to just get crushed the next 2 years and the market just continues to get crushed, our covered call income would basically offset almost all of the losses. Now, again, with that being said, when we pull back the chart, you'll notice that the S&P 500 never really goes down for more than 1 to 2 years. So holding it for 2 years, to me, I'm not afraid to do. Now, of course, if it keeps going lower, right? Let's just say hypothetically, what happens if the bear market does continue and it continues to go lower? Well, then we just keep buying more leaps, because at that point, right, let's just say we buy a leap here and a leap here and a leap here. Again, we'd be doing this on UPRO. If you bought a leap all the way down here and the market went up 100%, you can imagine the leaps that you purchased would be up 200, 300, 400% at that point, basically covering all of the leaps that you would have bought that loss. Now, I don't want you to be a degenerate. I don't want you to just go and empty your entire portfolio into leaps. So overall, the ultimate strategy would be, buying a leap maybe every quarter, every 3 months, right? So even if you wanted to go a little sooner out, right, because it's cheaper, naturally the closer you are to expiration, the cheaper it is. So let's say you didn't want to go 2 years, you want to go 1 year, let's just say you buy this one for $3,000, right? Now this is even more expensive than the one I bought because it's further down in strike. So options is always a formula, right? The further you are from the money or the further you are from expiration will always impact the price. But let's say you bought the 70, which is the same one. See, for me, the reason why I went 2 years is because, as you see, this $70 option is $1,800 for 1 year, or I could go 2 years and it's only $700 more. So I'm paying an extra $700 for a whole year, which, as you can imagine, when it comes to selling covered calls, it wouldn't be hard to make an extra $700 in the span of a year. So overall, the reason why I choose to do this strategy is 2 reasons, right? One, we see that the S&P 500 is always going to go up. When you do individual stocks, right, even though, yes, there's quote unquote no leverage, let's just say we look at something like Tesla, with everything happening in the Tesla news. Listen, does it look good at the moment? Yes, but who's to say how long it's going to take to recover, right? I always refer back to Baba, because Baba this entire time, which was multiple years, was just chopping around. But then when you put the S&P 500 chart next to it, those same years, it was going up. So the reason why I choose UPRO is because it's much cheaper, right? Instead of paying $500 a share, it's $70 a share. You don't have to worry about the stock you choosing not going up and being stuck in this chop. Naturally speaking, when you look at the charts of the S&P and the NASDAQ, it's really the only ticker symbols that you can guarantee won't chop around. And as an option buyer, this chop around is what's going to kill you, right? If you bought a leap 2 years out, this is what's going to kill you. The S&P 500 and the NASDAQ, it's never really going to happen. It's either going to go up or down due to the fact that it's diversified amongst the best companies in the world. So, in my opinion, the ultimate strategy to retiring quickly and as quickly as possible is going to be consistently buying leaps every 3 months, every 4 months, buying them 1 to 2 years out. The reason why, again, I like to go further out is because I'm selling covered calls. So if you go, let's just say you buy an option 20 days away, which at this point I do actually own a TQQQ option that expires in a couple days, because I like to diversify. I like to have shares. I like to sell puts. I like to do all of it. And if you've been following this channel, you would know that my portfolio has been a collection of just doing lots of different strategies that all in the long term do tend to work out in my favor. But with that being said, the reason why I like to buy out as far as possible is because I like to sell covered calls. And when you go closer in expiration, the problem is, let's say I buy an option 13 days away. Yes, it's going to be cheaper, right? It's only going to be $500. But if I wanted to then sell a call against it, and let's just say the market shoots to 82, I wouldn't be able to roll because the underlying asset is going to expire. So that's why I like to go 2 years out, because I want to be able to sell covered calls. And then if the market does shoot up, just continue to roll the covered calls higher and higher until I ultimately win in all ways. So if you enjoyed this video and you want to trade live with me weekly, learn from me, get all of my signals, we are still 100% free in our Discord, in our community. I'll put the link in the description. I hope to see you there. We will be closing it very soon. And again, I hope you learned from this video. I hope you enjoyed it. Make sure to like, make sure to comment, make sure to subscribe, and I will see you in the next video.